So, the big question is this: how are entrepreneurs and real estate investors like us, ones who want to grow our businesses and who are tired of paying for really expensive alternative lending? How do we tap into the most inexpensive money available and do it without the hassle of typical borrowing? That is the question, and this podcast will give you the answers. I'm Merrill Chandler, and welcome to the Are You Effable podcast. Welcome. This is Merrill Chandler, your host of Are You Effable? And this is the podcast where we not only explore what's keeping you from the funding that will create your dreams coming true, but actually flip the script and learn how to fit the underwriter guidelines for both personal and business lenders so that you can have every approval that you've ever dreamed of. So stay with me. I'll be back in a minute. We're going to be talking about how the system can support you in tripling the number of fundability points you get for every single installment loan that you've got. Car loans, mortgages, student loans, etc. We're going to knock it out of the park again. I'll see you in a second. And we're back. All right. So what is it about installment loans? We discussed a few episodes ago how installment loans contribute to the heft, the ballast, the weightiness of your credit profile, and therefore your fundability, right? But now we're going to talk about some insider secrets, things that most of us aren't aware of that are actually going to contribute to letting those installment loans just blow up in the most powerful, positive way, additional fundability points, right? How to use the system to create the most amount of juice. So we're going to use auto loans here as an example, but let's talk about kind of some of the features and the fundability characteristics of installment loans. First, when we were back at FICO, Brad and Hannah and I were talking with Ethan, or in this case, Brad and I were talking about the installment loan contribution with Ethan Dornholm. He's the chief scientist at FICO, and we found we had known certain parts of this, but he confirmed for us that installment loans actually don't contribute to your score until the sixth payment, because you're penalized on FICO and on your fundability for quick payoffs. How many of us have for whatever reason we don't want to be in debt, so we purchase a car? Many of us have the opportunity through a windfall, bonuses, tax returns, whatever, just some windfall allows us to have the opportunity to pay that car off. Well, FICO knows this, and remember, there's the 3, 6, 12, and 24-month increments of the 24-month look-back period. FICO doesn't even contribute score points until the sixth payment reports, because they want to penalize for quick payoffs. The next feature of loans is that they should stay open for 24 months. Remember, you're getting 16 times the value of the 3-month increment if you keep a behavior going for 24 months. So FICO told us that it should stay open for at least 24 months. Then anything more than 24 months, then the contribution to the scoring and fundability begin to flatline, right? That's what we call the time factor. So from month 25, 26, 27, from month 24 on, the account contribution flatlines. So we also learned that anything less than 50% balance on an account is the balance factor, and its point contribution flatlines. So the perfect installment loan is an installment loan that is above 50% and less than 24 months old, but that at 24 months you should refinance, release, renew that loan and keep it above 50%. Now, we put in here the thick file and a thin file, and what we mean by a thick file is all the accounts, open or closed, positive or negative. If there are 20 or more trade lines on your credit profile, then you have what underwriting measures as a thick file. That means you've done enough credit, you've been around. The problem is a lot of like we talked about the travel hackers and the folks who don't know what they're doing with their with their revolving accounts. Many people open and close, open and close, open and close credit cards. Those do not help you like like having installment loans that are opened for 24 months, paid off, and a new loan begun. So loans are what we want to fill up this 20 these trade lines. So the perfect credit profile, such as for my daughter, when I was building her credit profile for her, we wanted 3 credit cards, no more, and you can have up to 5 without any kind of penalties, but 3 credit cards is the minimum. But that means you need 17 additional loans. So what you want, the perfect profile is 3 open credit cards, no closed revolving accounts, and then installment loan, mortgage, refi. And by the way, installment loans do count when they're sold off, when mortgages are sold off. So if it goes to 2 or 3 lenders over the course of 2 or 3 years, those each count as a trade line, just so that you know. But all of your installment loans, your personal loans, the Winnebagos, the car loans, and the student loans, mortgages, etc., all count towards this thick file. A thin file is any file that's less than 20 trade lines. So I want us to remember that thick file, thin file metric, because it's going to help. I'm going to show you right now how to use your installment loans to get to that 20 that 20 files as soon as possible, and have a hefty, powerful, meaningful installment loan portfolio in the process. So let's take a look at an auto loan. A traditional loan goes something like this, and we're going to use 72 months or that's 6 years on an auto loan. They go all the way to 84. You can have all the way down to 36, etc. But the idea is that you engage the loan at month 0, and then you pay that off for 72 months in this instance, right? That's 100% of the possible credit score points for that loan. Now, what most people don't know is that FICO says that after 24 months, the balance of the points flatlines. So they front load points for that first 24 months. FICO front loads points in the first 24 months, and then the balance of those points are spread evenly across through the remainder 4 years. Now, it used to be, and I do not know, and I've not received, we're going back to FICO again. I do not know. One of the questions we're asking is what that front loading looks like. But before, in earlier versions of the software, the first 12 months, you got 40% of the points, and the second 12 months, you got another 30%, for a total of 40% of the possible points are going to be delivered in the first 24 month, which fits the 24-month look-back period. And then it flatlines. All the points just even out, okay, over the remaining, in this case, 4 years. Now let's talk about an optimized. This is you knowing the rules of the game. So same thing happens. At month 0, we purchase or lease. We'll cover leases here in just a moment, but we purchase or lease a vehicle. Well, in 24 months, we're going to get, let's pretend it's still true, because there is some heavy front loading going on. It used to be 70% of the possible points, but so let's call it that for now. I do not know, and I'm always candid about what I know for sure and what the working hypothesis is. So let's call it 70% of the points. Goes to month 24. Instead of continuing out for the next 4 years, I teach my clients, and now I'm teaching you, that at month 24, we repurchase, refinance, or release that vehicle. A new vehicle, in my case, I love leases. So I lease 24 months. I have 24 months. Sometimes I go 36, but I do 24-month leases in order to take advantage of this process. You can also refinance the same vehicle and you can repurchase, right? Depending on what you're capable of doing, etc. But if we do that, then we front load the next 24 months. We front load those very same points. You see what I did there? Now, the final period is we repurchase, refinance, and release in that second 2-year period. And as a result, we end up with 3 loans instead of 1, all of which contribute the highest or maximum number of optimization and fundability points, the highest number of FICO score points, etc. We get 3 loans instead of 1 in the exact same period. This counts towards the maturity of your file, that thick file. So imagine, if, of course, this is 6 years. So over the course of 18 years, it's going to add an additional. Now, remember, this is just the loans here. This doesn't count your student loans, mortgages, etc. The things that the other optimization loans. We talked in one of the previous episodes that that you need at least 1 mortgage, 1 auto loan, and 2 to 3 additional loans at any one time. Now, I don't recommend this with mortgages, because the refinance, unless it serves you to refinance, then we don't do this with mortgages. You can do this with student loans. If you have 10 student loans, you can, at 24 months, you can consolidate 3, 3, and 3 for a total of 9. 9 of those 10 student loans become 3 loans. Do that for 24 months. Then consolidate down again into 2 loans or 1 loan. There's a number of strategies, and you'd need to talk to your advisor team or go to the boot camp to get more details on all of this. So go to Get Funded or getfundable.com, getfundable.com, and click on the boot camp to find out how to literally in a weekend just be bombarded with all this actionable intel. What I'm telling you right now is this process is the process that you can create multiple loans. And because it stays within that 24-month look back period and it's above 50%, you end up with the highest points available on Fundability and for FICO. Now, in a sense, that literally is 300% of the fundability points during the exact same period. Now, people ask me all the time, they're like, all right, so what's the difference between a lease and an auto loan? There is one material difference, because every auto loan has a limit and a balance. And so that can calculate utilization, pay down rates, and send a message, as we'll be discussing in the next episode. It's going to send a message, a positive or negative message to your lender. Additionally, you have the ability to, if you're going to refinance or release that every 24 months, you're going to be able to create a reputation with your current lender, as well as send messages out in the front. So that 24-month look back period is vital for leases and for loans. So the only difference is that leases are for a lower amount. Let's say it's a $50,000 Jeep Grand Cherokee. I won't mention who's driving said vehicle, but let's say it's a $50,000 Jeep Grand Cherokee. If I finance $50,000, then what's positive is I'm going to have a $50,000 loan on my profile, which sends an amazing message to lenders. If I lease it, then I'm leasing the first 2 years or 3 years, which may end up being $20,000 or $30,000 of that $50,000 value. So I'm paying for the prime years of the life of that vehicle. And so my limit is going to be lower. Does that make sense? So if I have a $30,000 limit, or on my 3-year, I did a 3-year lease this last one, and so it was around $21,000. So so my loan shows a $21,000 loan amount, and then the balance continues to drop. So loans are better if you're looking for if you're looking to establish high thresholds for the amount of loans that you can carry or handle, which of course it contributes to business fundability, etc. I prefer leases simply because it's a lifestyle choice. I like a new car every 24 to 36 months, and I know that anything after that entire payment, I'm not getting optimization points, guys, for carrying a loan to term. So I get a lease 24 to 36 months. I'm in the optimal period of garnering points for that installment loan, etc. So that's our advanced strategy for optimizing your loans so that you can create a mature, thick file and not waste time. Your time to point ratio is the highest it can possibly be if you repurchase, refinance, or release every 24 months. Again, these are ideas to toy around with. If you have the means to do so, I only encourage buyer beware. I only encourage strategic debt, and I don't want debt to be a part of your process if you cannot afford to make the payments. I'm not about getting you strapped. I'm not about debilitating you or putting you in a financial cage. Okay, so be wise with these things. Again, I don't know if I'm giving a revolver, putting it in the hand of a 2-year-old, because I don't know your sophistication level. I don't know how you have the ability to execute on this, but it is vital that you be wise and talk to your other advisors, or go to Funding Hacker, or go to getfundable.com, join the boot camp, qualify for a strategy session for your fundability, and become a client. Make sure that you can have a team of people who are going to support you in every step of the way and customize it to your particular situation. So you guys have a spectacular rest of your day, and get fundable, guys. Hey guys, thank you for listening to Are You Effable? Please leave comments, because I would love to read about your aha moments from this episode. And be sure to visit fundinghackers.com to view the blog post, get important links, join our community, and much, much more. And you gotta tell your friends about this podcast. We want them to become effable too.